Hello everybody. In this video, I will talk about why you should not listen to any recommendations from any channel on the topic of active portfolio management. The authors of such channels always point out that it is not worth repeating after them and copying their portfolio. They remind you that active management often leads to serious losses. But in this video, I want to analyze in detail why it is really impossible to repeat after none of the active managers. Active and passive management are two types of portfolio management. What is active management? This is a fundamental and technical analysis, a study of the company's performance, attempts to assess the growth potential, find undervalued securities, and so on. In other words, it is the use of one's own or someone else's opinion to evaluate a company and buy individual shares in a portfolio. If someone tells you that because of the events in the world, it is now better to buy shares of medical companies, this is an example of active management. And passive management is the purchase of index funds, for example, the purchase of ETFs on the American stock market. Buying such paper, you buy hundreds or even thousands of different companies at once. You are buying the entire market. You may ask, who in their right mind should come up with the idea of investing in everything without looking to you? And not because it's easier, but because the profitability on average will be higher here. The fact is that active management implies that a person is trying to overtake the market, that is, to earn more than the market as a whole gives. But if someone was able to do this and beat the market by 5%, then it turns out that someone else lost and earned 5% less. Money is not taken out of thin air, so on average they show market returns. Active management raises many questions about its effectiveness. Many people believe that it is enough to analyze companies correctly and make profitable deals in order to become a winner. However, statistics show the opposite. Almost no one succeeds in this area. To make sure of this, you can turn to the best of the best, active management funds run by real Wall Street gurus. They are real professionals, and if anyone can outrun the market, it's them. But their results leave much to be desired. Most show profitability lower than the market. Let's look at the beginning of 2001, for example. At that time, there were 2,758 active management funds, and only 541 of them, that is, only 20%, outperformed the market in 10 years. But even if you invested in those 20% of the winners, you would still lose. Over the next 5 years, only 200 of them, that is, only 37%, were able to beat the index. This suggests that most funds are simply unlucky, far from reflecting their professionalism. Their results are unstable and prone to accidents. But then the question arises, why does almost everyone lose? After all, someone has to win. But the fact remains that almost everyone loses. One explanation may be related to the high fees that active management carries. Buying one index for all its companies is significantly different from buying and selling several stocks and periodically changing the portfolio. Commissions eventually take away almost all of the profits. If you look at history, then already in the 97th year Mark Hulbert conducted research on professional active management fund managers. And his conclusion is very clear. They do not have professionalism, and it is almost impossible to beat the market. If luck supports some managers, it is only an accident, not a manifestation of their skill. And this is a well-known fact. Realizing this, more and more people are moving away from active investing into passive investing. Even Warren Buffett made a bet in 2013 with hedge fund managers, according to which in 10 years they would not be able to show higher returns than simply investing in the S&P 500, an index of American stocks. Naturally, Buffett won, and from his position, it can be said that due to professionalism, it is possible to overtake the index. Warren Buffett is a man with huge connections and is familiar with the best analysts on the planet. He prefers to leave his money in passive blind management, without choosing individual specific securities. Why? Because it is almost impossible to beat the market, and it is not even worth trying. Such an attempt reduces diversification, increases risks and commission costs, and the result is likely to be sad. He recommends that all people, both large and small investors, stick to index funds with low fees. If you make a deal by buying a separate paper, then someone is selling it to you. And this player is hardly more stupid than you. Do not overestimate yourself by buying some stocks and avoiding others. You are playing against the collective mind of all other market participants, primarily against investment funds and bank hedge funds, which have the strongest influence on the market. These organizations have hundreds of millions and billions of dollars under management. The quote from Charles Ellis, a former lecturer at Harvard Business School and Yale School of Management, as well as a former director of the investment company Vanguard, speaks for itself. Look at the football match of the professionals. The guys on the field are much faster, stronger, and more willing to move and bring more results. You'll probably say, I don't want to play against these guys. But 90% of the trading volume in the stock market is created by institutional investors, and half of this volume is accounted for by the 10 largest investment companies in the world, who are deeply committed and extremely well prepared, because these are the smartest people working all day in the market. And you know what? I don't want to play against these guys either. I have nothing more to say. Why do people make mistakes when playing on the stock exchange? Active portfolio management is a bad financial decision for almost all people on the planet. Almost everyone thinks they are smarter, stronger, and better than others, but we tend to overestimate our abilities and underestimate others. I suggest you be more modest and careful. What would you say to your friend if he decided to fight Mike Tyson in boxing? Playing against a market made up mostly of professional Wall Street managers is not a good idea. It's not even your weight class. But you shouldn't be upset either. First, you have the opportunity to invest the entire market at once using index funds. Since such an opportunity was not available 50 years ago, you can invest rationally the entire market with minimal commissions. Secondly, there are ways to increase or decrease the risk in order to slightly adjust the expected profit. In the following videos, I will tell you how to do this. So be sure to subscribe to my channel and like it if you are interested. This will greatly help the promotion of the channel. Thank you. See you soon, friends.